Hello and welcome to Steps to Investing. Here's what's coming up in the show. Well, joining me in the studio today is Holly Black.
It's not just profits that are driving investors today. Yes, they want a financial return, but that's not the be all and end all.
Holly is a writer, journalist, broadcaster and runs a blog about freelancing and finance. Holly, welcome to the studio.
Hello.
Perhaps you could start by just telling us a little bit more about what you do.
Yeah, you said most of it, but I write about personal finance and investing. I did that for a number of publications for a few years and then went freelance a couple of years ago. So now I write for national papers like the Sunday Times and the Daily Mail, and for more specialist publications like Morning Star and Money Observer.
So when you're writing those pieces, you're talking to people in the investment industry. How is the investment landscape changing, do you think?
So I think there's a lot more focus on transparency at the moment. I think where people are becoming a lot more digitally aware and all the information in the world is at our fingertips, we're kind of expecting the same from investments as well. So we want to know how much things are going to cost in pounds and pence. We really want a daily update on portfolios, not monthly or 6 weeks old. And another thing that's sort of coming through, particularly for younger investors, is this focus on ethical and socially responsible investing, which is a really interesting trend.
So the thing about transparency, do you think is that being driven by asset managers, fund managers themselves? Is that being driven by the regulator? Is it individuals wanting to know more? Where's that coming from?
I think it's all three. So I think the regulator's been a bit tougher since the financial crisis, and there's this crackdown on making sure people understand what they're investing in and understand what they're paying and why a fund might be worth that over something else. From asset managers' perspective, I guess maybe they want to help people because that's how you get people to invest, because if we don't understand something, we don't engage with it. Mm-hmm. And then from the investor's perspective, there's this pressure to get rid of the jargon, talk to me in plain English and tell me what you're doing with my money.
And just picking up on the point you made about younger investors, why? What's driving younger investors to think about ethical or social investing with a sort of social purpose?
I think, and this is obviously broad brush, this doesn't apply to everyone, but there's a lot more consciousness about how our daily lives are impacting the world around us. And you saw that with the school children protesting last week about climate change. So it's not just profits that are driving investors today. They want a financial return, but that's not the be all and end all. Mm-hmm. They want to know that their money is being put to good use. So there's this movement of impact investing, and it's about picking out companies which are having a social and economic or environmental positive impact with the money they're investing, and avoiding those that aren't doing so good or making so many strides. And that's true even at a boardroom level of employing more women or having more racial diversity as well.
That's interesting. What's happened then during 2018? How would you assess what's happening in the market in 2018?
2018 was really interesting because basically, if you started investing any time over the last 10 years, you probably think you're an amazing, talented investor because anything you put your money into went up. It was brilliant.
Oh, come on, not everything, but I take your point. A lot.
You would have done, quite well in barring a few blips along the way.
Yeah.
And last year we saw a couple of major sell-offs and some real rocky periods where people's money was not going up in a straight line anymore. So I think it's actually a really good thing because the last 10 years have been the anomaly, and last year was a bit more what you should expect.
Like a reality check, I guess.
Kind of was. I even spoke to some fund managers who've been in the industry for 10 years. So in whatever career you're in, that's a really good CV, that's a long track record, you've got a lot of experience. They'd never seen a sell-off before. They didn't know what to do with it.
Right.
So it's not just end investors who got a little bit caught off guard, I think. But that was a major change.
What was driving that? Is that the state of companies? Is it politics? Is it something to do with the environment? Why was that volatility in the market?
A lot of it is just uncertainty. Investors and stock markets get really nervous when they don't know what's happening. So in the UK, that's Brexit. I mean, we still don't know what's happening there. Between the US and China, there was these trade wars. In India, there's elections coming. A lot of the emerging markets were quite hit by a rising oil price. And then there's the question mark still over how central banks start to rise interest rates and rein in all that quantitative easing, all that money they've been pumping into the system. So there is a lot of uncertainty. It's easy to see why people are nervous.
And has any of that dissipated? So since the beginning of the year and looking forward into 2019 to this year, have any of those worries gone away, do you think?
I mean, absolutely not. No, I don't know the answers to any of those questions. And actually, at the beginning of the year, it's a time when I go to a lot of conferences and hear fund managers talking about all their big ideas and what the themes of the year are going to be. And I sort of felt sorry for a lot of them this year because they were basically saying, I don't know.
Don't know, yeah.
But all we can do is, react and understand and believe and focus on the long term in what we're doing.
It's not often you hear people saying they feel sorry for fund managers.
No,
so
I know. It's those poor wage packets they get that really gets my tears.
So those challenges haven't gone away, but the market has had a good January. Things have come back a little bit, I think, from where they were at the end of last year. That said, looking forward into 2019, do you think there's further volatility to come? Do you think things are going to be as spiky as they have been?
Yeah, I do think, because we've got, Brexit potentially in March. We've got Indian elections, April, May. There are a lot of clouds still on the horizon. We don't know how those trade wars between the US and China are going to play out. But what professional investors would say is that is where the opportunity lies, because if you can pick the winners or be brave enough to pick something that share price has fallen, but maybe only because people are scared, not because there's an actual reason for that. That is actually where you can really start to make some good returns. And that's where a fund manager adds his value, rather than if you pick a tracker fund, which just does exactly what the stock market does.
Yeah, that's a good point. I mean, it's having that, as you say, that nerve, I suppose, to invest in something that perhaps fundamentally there's nothing wrong with it, but it's just the noise around it that has driven its value down. How does that affect a retail investor, though? What is it that they should be thinking about in these periods where you've got volatile markets? Is it a good time to think about investing?
I mean, it's great. It's like you said, the last couple of months of last year were scary and there were sell-offs, but every investment association sector posted a positive return in January. So if you would have held your nerve, or even added to your investments or started investing at the end of last year, you'd have had a great start. You're probably really up by now. So that's great. So I think that the main thing for investors is not to panic. And the way to not panic is don't check your investments. Don't do it. And that sounds really like a contrary belief, but if you check it, it's easy to panic if it falls, but it might only fall for a day, and you just leave it to the professional to worry about.
I suppose that's one of the issues, isn't it? Is that it's the difference between that those short-term blips, or even longer-term months of worry, versus the fact that actually most investing is done over the very long term, over years, or in fact decades in some cases.
Yeah, I mean, the most common reason that everyone will be investing is for their pension, and you're not going to be touching that for 30, 40, I mean, if you're just starting out in the workplace now, I don't even know how many years. So it doesn't matter what happens this year, because all you need to worry about is how your money can compound and grow over those decades.
And I wanted to ask you a personal question, if I may. Can you tell us a little bit about your kind of personal investing story? How did you get started? Where are you now?
Okay. So I started investing in 2013. So I'd been writing about it for a couple of years, and I sort of almost felt a bit like a hypocrite, because I was making judgment calls on various funds or sectors, but I kind of wasn't putting my money where my mouth was. So I was like, okay, let's open up a stocks and shares ISA and actually back some of these funds that I believe in. And it's gone quite well, because that was I'm a talented investor, right? So I had a technology fund, and that did amazingly well for a while. I had a global equity fund and a smaller companies fund, a couple of racier ones, but it's not all been great. I also invest in a gold ETF, so that tracks the price of gold. So I did that because you're supposed to have gold in your portfolio as an insurance policy. And what that basically means is that gold ETF has lost me money every single day since I've owned it. But apparently that's really good because that means that everything else is in good shape. That should only do well when everything else is.
Ah, I see. So it's like a hedge, I suppose, against everything else.
But it's not very nice to look at. It's got a red number by it.
And do you ever buy individual companies yourself, or do you rely on fund managers to make those choices for you?
I don't buy individual stocks, no, because it takes a lot of work. You have to track those companies. Every time they have a bit of news out, you have to track that, react to it. And also I think in terms of diversification, it's quite hard to achieve that for a share portfolio.
And what about choosing a fund manager? How do you, there's so many of them out there, so many different funds and investment trusts, how do you make those decisions?
Well, I'm obviously in a really privileged position where I get to speak to some of those managers. And sometimes you can speak to one who's so charismatic and can really communicate what they're doing, I'm not doing anything. And that's it. I mean, that's a good sign if someone believes in what they're doing. But I mean, I think the easiest place to start is by looking at what they're aiming to achieve, their track record, their strategy, and the actual stocks they're investing in, and if that aligns with your beliefs for the long term.
I wanted to ask you about that actually, because obviously speaking to managers, I suppose, gives you some insight into the do's and don'ts of investing.
Yes, definitely gives me some insight. It means I know the do's and don'ts. It doesn't mean I always follow them. So you are in a incredibly privileged position. But I don't always follow my own advice. So one thing I really, really believe in is regular investing, where you set up for a fund supermarket just to automatically add to your holdings every month on a direct debit. And that means that you don't panic when the market falls because you've got no control because that direct debit's there. You don't have to remember to invest if you go on holiday or just don't look at it for a little while. And it means you automatically buy fewer units in a fund when they're more expensive and more when they're cheap, and that gives you a better deal over the long term. Fantastic. Regular saving is amazing. I don't do it.
Oh, really?
Just because I haven't got around to doing it. Just like everyone else, it falls down the priority list.
On that list.
Yeah, it's quite high up the list.
That's really interesting. So just to summarise what we've been saying, can you give us your sort of top three, if you like, hints and tips for people thinking about investing in this market, in these sort of more volatile times?
Yeah, of course. So I say drip feed your money in, because if you invest it all in one big go and then there's a fall the next day, I kind of always say that's like starting a football game 1-0 down, because you're immediately in a loss. So if you just drip feed on it, set up that regular savings thing, £25 a month you can usually start that at, then it becomes just a habit and ingrains. And then the second thing is don't look. Check your investments maybe every 4 to 6 months, just to check that the manager's not gone awry and started investing in a load of things that he didn't mention before and wasn't supposed to be. That's just enough to kind of keep everything in balance. And then number 3 would be check costs and charges. Don't overpay for something that is doing the same as something else but is charging you 3 times as much.
That's great advice. Thank you very much for your time. That's all we've got time for today. Thank you very much for watching. Goodbye.